Charge of income tax सेक्शन 4। अब क्वेश्चन ये आता है कि when you want to charge income tax, on what income should this be charged? Should it be the income of the previous year? Should it be income of the same year? Or which income should be charged? Now, as a general rule, income tax is charged on income pertaining to the previous year in the assessment year. But there are some exceptions to this. First, let's understand this. Then we will discuss the exceptions. Charge of income tax for income pertaining to the previous year. Section 4, subsection 1. Where any central act enacts that income tax shall be charged for any assessment year at any rate or rates. When we talk about a central act, it is actually the Finance Act which is passed every year, and it specifies what will be the rate at which income tax will be charged. So where any central act enacts that income tax shall be charged for any assessment year at any rate or rates, income tax at that rate or those rates shall be charged for that year in accordance with and subject to the provision of this act in respect of total income of the previous year of every person. Suppose the Income Tax Act prescribes, let's take a case of an Indian company, and this will be easier to understand. Suppose the Finance Act prescribes that the income tax shall be charged for any assessment year. Let's say we talk about 2017-18 assessment year at any rate or rates. Why this word rates is used? Because let's say in case of Indian company, depending on their turnover, the rate was 25 or 30% during this year. These rates may be different for different sources of income. Business income may be taxed at 30%. Long-term capital gain may be charged at a lower rate. Income tax at that rate. That rate means the rate that has been specified, or those where more than one rate is specified, shall be charged for that year. Which year? Assessment year 2017-18 or previous year 2016-17 in accordance with and subject to the provision of this act. Which means the rate is 30%, but if there are any exemptions which has to be given or some disallowance that has to be made under the act, that has to be done in respect of the total income of the previous year of every person. Now, tax is on the income of the previous year. I think this is the crux of this entire section 4, subsection 1. You cannot charge as a general rule income of the assessment year 2017-18. So assessment year 2017-18 means 1/4/2017 to 31/3/2018. You cannot charge income tax on the income for 2017-18 in assessment year 17-18 as a general rule. But definitely there are some exceptions to this rule, which is given in the PROVISO to section 4.1. And what are these rules? This rule specifies that where by virtue of any provision of the act, income tax is to be charged for other than previous year. If the act itself specifies that you can tax the income not of the previous year, but some other income also, income tax shall be charged accordingly. As an illustration, there are these various sections. Sections 172, which deals with the shipping business profits of a non-resident, right? You have section 174, 174A, 175 and 176. All of these deal with different provisions. So let's say 176 deals with a discontinued business. What if someone closes down the business? In that case also, should the government wait till the end of the assessment year to collect the taxes? The reason why these sections have been defined is that in these cases there is a possibility that if the tax is not collected upfront, the person who has to pay the tax may actually not pay the tax at all. So let's say in case of a shipping business of a non-resident, once the ship leaves the country, it goes away. If he does not come back in the next assessment year to pay the taxes, how are you going to recover that? For a discontinued business, the business is closed. What if the person who was running the business runs away and doesn't pay the taxes? Therefore, instead of waiting up to the next assessment year, there are provision that in these cases the taxes can be collected upfront. Similar is the case with section 174, 174A and 175. So in case of 174, it is in case of a person who is leaving India. You obviously want to collect the taxes upfront. There may be certain association of persons or body of individual who may be formed for a particular purpose. The purpose is over, they may or may not exist. All these cases are to protect the interest of revenue. Now, once the income is chargeable to tax, then in all those cases, in respect of income chargeable to tax under section 4 subsection 1, which is what we just discussed, that if the income is chargeable to tax during the previous year at a specified rate, income tax shall be deducted at source. So either there will be a TDS or paid in advance, that is advance tax, where it is so deductible or payable under any provision of this act. Now, why is this relevant for a non-resident? A non-resident, by their very nature, are situated outside India. Once the money goes to the non-resident, if tomorrow he does not pay taxes, there is no way the Indian government can go into their country and recover it. Therefore, there are provisions that TDS has to be deducted from such payments, and this deduction is predominantly covered by section 195. There are some other sections which provide for deduction of taxes, and advance tax payment provisions are equally applicable to non-residents also.